Welcome back. Let's go to Lyle Stein. He's president at Forvest Global Wealth Management. He joins us this Friday morning to take a look at what is ahead for the day in the market scene. Thanks for joining us today.
Good morning.
So much livelier August, I would say, than typical. Let's start with the new retail numbers coming out of the U.S. 0.5 increase for July. It looks like vehicles helped to push that number up. And I understand there's a September deadline in the U.S. for any discount on EV vehicles. So it could be people sort of buying ahead of that. But overall, what's your take on the number being up for July?
Well, it was good to see a positive piece of news on the retail sector, because when you look at the second quarter earnings releases for the companies that are actually involved in that, they were not pretty. Consumers have been tightening their belts, but consumers are pretty smart too. And look at the auto sales. I think a lot of that was pre-purchasing, whether it's the EV sales with the deadline in September or just regular sales ahead of what might be tariff implications. Consumers are smart. Unfortunately, somebody's got to pay the piper, and it was the auto company. So while the car number was good from a sales perspective, the profit numbers from the auto companies were not good at all. And so there's a dichotomy here, and it's this kind of uncertain dichotomy that's giving the market kind of conniptions.
Okay, so let's talk about that dichotomy, because eventually it will no longer exist, is what we're thinking, right? Right now, some of the retailers or the manufacturers are picking up costs of tariffs that have come through that eventually have to, I guess, get passed on to the consumers. What are you seeing when we read the inflation data out of the U.S.? We know core inflation was up more dramatically than expected, but headline inflation isn't. So what's your read when you look at those numbers?
Well, this is a tough one. And, everybody was excited with the CPI number not moving. The jobs number wasn't great, but it wasn't a recessionary indicator. We didn't have any negative job growth. But I think yesterday was a cold slap in the face with respect to perhaps what the tariffs are going to mean. We don't try to call this stuff quarter to quarter, but the really interesting thing when we look at the market in general is the level of profit margins that companies are earning. What percent of gross revenues are basically going to shareholders or financial interests, and that's at record highs. The stock market's at record highs. Margins are at record highs. We're just only now seeing the impact of tariffs, and what will that do to earnings expectations, which have been actually going up. We had a good quarter. Second quarter earnings, by and large, were ahead of expectations. Analysts have raised their numbers, not just for this year, which had been going down, but for next year and 27 as well. And the question ultimately becomes, what will those tariffs look like? Is it a short-term, one-time impact, as some are saying, or is it going to reverberate through and, show up in wages and all the rest? And that's what the market is concerned about.
When you look at the earnings, you mentioned that people delivered, right? People delivered on profit. The margins are there. However, when you dissect it a little bit more, tech was strong. But then, for example, we are seeing some stalling on the construction front. We spoke with the CEO of Bird Construction yesterday, and he was saying people are just delaying their projects, right? They don't want to put the money in until they figure out what is around the corner. And so millions of dollars in projects are literally going to sit until they figure it out. Are you seeing, as you mentioned, that dichotomy of tech being able to deliver, everybody else not as much?
Absolutely. And when you think of the Magnificent Seven that really are at the forefront of the market rally that we've seen since the April lows, you get it. They've had very good numbers. Their margins have been strong. But even their growth estimates for 26 and 27 in terms of top line revenues are soft. Then you look at the retailers, and they're hurting. Their margins have been squeezed. And then you've got everybody else in the middle, such as the story you just referred to from Bird Construction. So it's hard as a CEO to make hard long-term investment decisions in this period of uncertainty, because you really don't know. As a Canadian company, think about tariffs. We talk about the 25% on many of the commodities. The USMCA, though, is subject to renegotiation next year, if not sooner. And how do you make a long-term 5-year capital investment decision when you really don't know what's going to happen? That's what's causing, I think, a slowdown in much of the economic activity in North America.
So it's the lack of the deal for Ottawa and Washington. You think that is still that drag on the Canadian economy? And as you mentioned, if the deal pushes to next year before they negotiate or really come to an agreement, that drag could last a long time.
Oh, exactly. If you're making an investment decision in a plant, let's just say in Waterloo, just to pick a city, it's going to take you 6 to 9 months to build. You've got to do the pre-construction. So you're making a decision 18 months out, and you have no idea where your potentially biggest customer is going to be with respect to what the cost of importing the product that you've created is going to look like for that American consumer. That's a really hard thing. All this talk about, well, we're going to have a, half a $1 billion plant here or a $3 billion plant in Texas or whatever. This all takes time, and a lot of things can happen in very, very short time while the construction is occurring.
Okay, so if you are a betting man, are you thinking that the consumer prices will start to rise sort of towards the end of the year as the manufacturers or retailers start to pass through?
I think so. I'm not talking like, let's call it 2.8% inflation. I don't think it's going to get to 3.5 or anything like that at all, because there's other signs of slowing down. But I think the bias is for numbers to be stronger. Now, we know the big element is in housing, and housing, that was a good component. But services inflation is still there. And, all you got to do is look at the Air Canada strike, and you can see what could happen to service prices. This is an issue that people are just going to have to wait and see. But markets never want to wait and see. It's 2 interest rate cuts going forward. Money's cheap. Let's go buy assets. Let's go buy stocks.
Yeah. Lyle, I will leave it there with you. Thanks very much for joining us this morning. Lyle is president at Forvest Global Wealth Management. Thank you.